All right. Okay. Well, look, thank you so much for this wonderful event and for this opportunity. I think all of us here have significant exposure to digital assets, and that's what is interesting to us. Now, by way of brief introduction, I'm talking about DeFi Technologies, which is a company that I work for, but our largest asset is actually a company called Valor, which is very much like a 21 shares. It's an ETP issue. We've actually worked on partner products with Bitcoin Suisse, and what Valor does is wrap digital assets into exchange-traded products and list them on capital market-friendly exchanges. Oh, a little closer. Oh, sorry. I don't need to start over, do I?
I don't think so.
Okay. So my apologies for that. I'm not used to speaking. But yeah, so what Valor does is wrap digital assets into exchange-traded products and list them on exchanges. Now, one might ask, why is that important? Well, I think over the course of the last 2 or 3 days, you've probably heard a lot about crypto adoption. We had a great presentation about indices. But at the end of the day, there's a mismatch between where the money is and how it gets into these new assets. And what is exciting is, I think now we're actually in an inflection point where we're seeing capital markets broadly accepting the power of digital assets. So I'm going to talk about DeFi Technologies, not only in the context of our company, but in the context of what I see as a move towards broad adoption, and what I see as some problems that we face in the industry, and the challenges people have in investing. Whenever we look at bridging traditional finance with innovative exposure to digital assets, what exactly does that mean? Now, in my previous life, I worked as the head of venture capital for a layer 1 foundation within Hedera. Hedera is known for being an enterprise type layer 1. But the interesting thing about my time there was I realized that a lot of companies that build projects on blockchain, they don't actually solve the problem. They often are trying to create innovative solutions, but they're not solving problems that people have in their everyday lives. And the same thing happens whenever you try to think of investment products and adoption for people. So if I speak to my mom, for instance, who is a retired physician, obviously in a different age demographic, and she's listening on the news about how fantastic Bitcoin is and wants to access it, how many people here would be able to tell somebody who's in their 70s or 80s with confidence how they can go and put their hard-earned retirement savings into the investment of a digital asset, right? I don't know, are many people here comfortable enough to be able to speak to a retiree, an 80-year-old, as to how they can access it with confidence that, of course, there's risk in the underlying digital asset, but they're not going to make a mistake and invest in a platform where they can lose their money, or make a mistake and perhaps invest in the wrong token. This is something that I think we need to come together and solve as an industry, and it's certainly something that we're committed to working on as DeFi Technologies. The short answer to that is, anytime my mom asks me what exactly we do, it always ends up with saying that she doesn't understand it. And I always end up saying, Mom, it's probably best if you don't try to invest in crypto directly. Now, a little bit about our company and what we do strategically and why we think it's important. I think it's very, very difficult in the digital asset space to be exclusively in one area. You can be an asset manager, but then you have to be concerned about potential disintermediation. So if we are focused, for instance, exclusively on making ETPs, well, every day custodians get better and better at encouraging institutional and retail adoption directly. But if you focus exclusively on, say, a platform for direct adoption of digital assets, well, you run into a problem. And one of the problems is, and I learned this very, very recently, a lot of Fortune 500 firms that talk a great game about adoption of digital assets, if you ask them, oh, look, we built an application, we want you to use it. This application leverages Hedera or Sway or Solana, so you need to pay gas fees for a traceability application. So would you mind setting up an account so that you could have some Sol tokens or Cardano tokens or what have you? They'll literally look at you, Fortune 500 company, and say, yeah, that's interesting, we love the application, but compliance won't let us buy the tokens. And you're like, wait, you've just invested $500,000 million in building a traceability application, and you knew that this application was using blockchain. What do you mean compliance won't let you buy the tokens to pay for gas fees? It's not speculation. And they're like, yeah, well, unless it's hyperledger, it's just not going to happen. Then you're like, well, those tokens are going to cost you maybe $50 a month. And they're like, yeah, but no. They're like a Fortune 500 firm. So what happens is, even though a lot of firms have an interest in adopting digital assets, they do not allow themselves to actually touch them. And this is a problem. It's a big problem. Because until that comfort level is reached, we're always going to be a little bit stuck on the fringes. And for this reason, you sort of need a portfolio approach until such time that on-ramps and off-ramps have been completely smoothly defined. One of the things that we're finding is, and I think this is going to be a problem for the West, as in for the more, I don't know if this is politically correct, but the more developed countries versus developing countries, is we're so focused on hyper-regulation and congratulating ourselves for this regulation that we tend to miss the boat on the actual development of underlying technologies. A case in point, I'm not sure if many of you have ever heard of the phone-to-phone payment protocol called M-Pesa, made popular in Kenya. Has anybody heard of M-Pesa? Yeah, well, M-Pesa was really, really effective for a pretty dumb reason. One of the dumb reasons that M-Pesa was effective is because the landlines didn't work very well in Africa. Like, landlines require a lot of maintenance. So a lot of people didn't have good phones in their home, but mobile phones they could have, and the banking system itself was very, very stuck and archaic. So in a lot of the poorer countries, you have a lot of unbanked people. So they developed this parallel system of being able to exchange value and pay for goods using phone credits. The same thing is happening today. Whilst many governments are somewhat bickering and hampering innovation whenever it comes to things like stablecoins and making the bar very, very high, I can tell you that if you are living in a country where inflation is running 20-30% a quarter, you're not, and gaining access to a bank account is incredibly difficult. You're not overly concerned about what a regulator thinks. You're just going to gain access to stablecoin. And so while stablecoin adoption in many developed countries isn't a must, in the parts of the world where population is highest, stablecoin adoption is running rampant. Now, why is that important? Well, how many, I don't know in this audience if many people here are actually Web3 application developers or build applications on Web3. Okay, cool. So we have like one or two, not too many. But we know that Bitcoin, I remember one of the people that was presenting, they even showed in their index, I actually think it was Billionaire, they showed in their index that Bitcoin is highly weighted, but it occupies a very unique space, right? Remember they said you have to value Bitcoin differently. Well, one of the reasons why Bitcoin occupies a very unique space is because it doesn't do anything. Like, there are very few applications that are built around the Bitcoin. There are many applications that are built around the altcoins. And why the altcoins are therefore important is because what I think is a killer app of the Web3 generation, stablecoins, all stablecoins are running on altcoins. And so whenever you are an institutional investor or you're creating institutional investment products, we're not only thinking about, wrapping Bitcoin into an ETP. We're also thinking about what the potential future can hold for the altcoins on which these big applications are running. And the biggest of these applications in the world today are things like stablecoins. So as a company, it's important that we're not looking at just the straight asset management aspect of it. We're also trying to look at the companies that facilitate the use of that technology. So one of our portfolio companies, for instance, is an entity called Stillman Digital. It's not written up there, it's in a subsequent slide. But Stillman Digital is a liquidity provider. And in the last 2 years, I think Stillman Digital has processed some 31 or 32 billion in transactions to stablecoin on-ramp and off-ramp, and centralized and decentralized exchanges. Now, the reason why we felt the need to take a position in a company like that and indeed acquire it is because we're looking at the entire digital asset space, and we're realizing that there is a really big need for integration with standard fiat rails, like people who have regular USD or euros or pounds, and the digital money. And why do we think that need is going to continue to grow? Well, because more and more people in the world, particularly in the developing countries, emerging countries, are realizing that there's an alternative to holding Ghanaian cedis or Nigerian naira or Kenyan shilling that depreciates at a very, very high rate whenever they have to buy goods and services from international markets. So there is a real imperative to use these technologies, to use these different products, and our approach as a company is that we have to be a portfolio company that supports these technologies because we really don't know what the winning technology is going to be in 5 years or 10 years, right? And I think that's the biggest thing that I've learned from being in this space. It's less an exercise in correlation and statistics, and it's more an exercise in trying to interpret a Jackson Pollock or being in a street fight. You sort of spend your time just reacting as quickly as you can, as effectively as you can, in order to remain relevant. And if you don't believe me, I think if you think back to, I was going to say a few years, but it could be 1 year. It's like 1 year in the digital asset space is sort of like, it's sort of like 10 years in a regular business. But I'm not sure if you remember, like, when NFTs were very, very popular, and people were investing in NFTs like they were something special, they did something special. Now, to some extent maybe they did, but the reality is the market and utilization decided that they weren't the killer app. And all the while there were quiet firms like Tether and Circle doing their thing in a very, very muted way, creating a lot of value. But today, if you look at where a Tether and Circle are, I read someplace that Tether is the 18th largest holder of US Treasuries in the world. That's putting them on par with sovereign nation state. But if you think of that, if that is the case, think of this. That means that Tether's turnover is actually higher than the global market value of all digital assets. Because remember, earlier today, the gentleman that was speaking about the indices cited a statistic that the market value of Bitcoin is about 2.3 trillion. I think today it's probably around 2.3. At a high, it was about 2.35 trillion. And what's interesting is the market value of the entire digital asset space is about 3.9 trillion, right? Now, that sounds like a lot until you juxtapose it against the market value of NVIDIA. Does anybody want to venture a guess at what that is?
3 trillion.
It's what?
3 trillion.
Yeah, it's like 4 trillion, right? So one company is greater than the entire market value of everything we're so excited about, right? But then what gets even more interesting about that is we always talk about, oh, Bitcoin is analogous to gold, right? It's immutable, there's a limited supply, it's somewhat deflationary. But what is interesting, and people often want to figure out, well, how high can Bitcoin go? Right? What is the true value of Bitcoin? Well, if Bitcoin is truly analogous to gold, we should be running comparables against the market value of gold. And we know that the approximate market value of gold in the world today is, interestingly, about 23.5 trillion. If you like math, you realize that that is 10 times what the value of Bitcoin is today. Now, it was actually a friend of mine, Elliot Johnson, who created, very recently, like this summer, created the world's, Canada's first Bitcoin treasury company that highlighted that ratio to me. But that gives us a sense of where an asset like Bitcoin can go to achieve equilibrium. It can actually do about 10 times in order to fulfill its mandate of being the digital form of gold. And I mean, 23.5 trillion, or Bitcoin 10xing what it is today, that sounds pretty good, right? That sounds like it would be good for the entire market, especially when you consider that at every price inflection point, the altcoins become a greater proportion of the total crypto digital asset space in terms of market valuation. But then, let's look at the market value of equities. Because we can't compare, we can't congratulate ourselves for hitting 4 trillion if we don't look at what the comparables are. The global market value for equities is $125 trillion. Right? So this goes to show that we're very much just in the beginning. And it's highly unlikely that we're going to maximize our value just from the cash flows of gas fees on layer ones. I mean, this is my point in this meandering process. The way we're going to maximize value is by solving actual problems with digital asset infrastructure. And this is what interests me so much about stablecoins and the fact that Tether now holds more US Treasuries than many sovereign states. That's unheard of. Because what are treasuries used for? Well, treasuries are actually used to determine our foreign exchange rates. That's why central banks issue them. That's why they buy them back. So if you have private companies holding more than the countries, what does that mean for the future of monetary policy? Right? This is important. And when we talk about treasuries, well, that is interesting because, as I said, equities are about 125 trillion. Who wants to take a guess at what the market value of sovereign debt is? Sovereign debt alone, 100 trillion. World Bank issues about 60 to 70 billion dollars of paper. The World Bank issues 60 to 70 billion dollars of paper per year, per annum. So sovereign debt alone is 100 trillion. When you add in corporate debt, you're looking at $325 trillion. Right? So when we congratulate ourselves or think that we're doing well in the digital asset space, we really aren't. We're doing about as well as NVIDIA. But then, whenever the market drops 5% and you have analysts clutching their pearls and crying that, oh, the world of crypto is over, you have to put that into context, because one thing is certain: as stablecoins have become such an important part of the digital asset space, the days of people being satisfied with T+2 settlement, that's not going to last much longer. We're going to be putting more and more assets on chain. Right now it's hard. Right now, we have great firms like Securitize. We have great projects like some of the things that we do, which I haven't really talked about, but I've been told I have 5 minutes, so I'll spend the last 2 minutes actually telling you about what we do. But yeah, we're going to be seeing that more stocks, more debt, more equities are going to be put on chain. And as they are put on chain, they're going to require the resources of layer ones. Now, that sounds fantastic, but most of the companies that can afford to put all these assets on chain can also afford to fork their own layer one, rename it, and make it their own. So we're probably going to see a degree of rationalization amongst these chains and altcoins that are supposed to be driving the future, but we'll see about that. So this is just some stuff to think about. Now, in terms of DeFi Technologies, which is the company I'm proud to be the president of, we have a couple of business models, but in light of everything that I've discussed today, you're going to see why this portfolio approach is important. Our biggest asset is Velour. And Velour is an entity that we have listed something like 85 exchange-traded products, primarily on exchanges throughout Europe. Our strongest market is in the Nordics, out of Sweden, but we do have product listed in Switzerland. We have a joint product with Bitcoin Suisse that is an index basket of crypto digital assets. But that is our flagship portfolio product company. We have a research company because we think that going forward, the type of traditional analysis that is used in assessing equities and debt, it's going to have to change. We know that it's changing. But the funny thing, if we were to ask anybody, how do you value Ethereum? Having been trained in financial engineering, nobody can do it, because if you use a discounted cash flow model, the valuation is not favorable. I think we can all accept that. Then we have the entity Stone Digital, which is a liquidity provider, because in the magic of Web3 world, nobody thinks that liquidity is important. And I was really glad when the lady who was speaking about investing in token projects was talking about the utilization of tokens, because I saw that myself in our VC practice, that many projects would come in and say, yeah, the token's great. But you say, well, if nobody is using it, how would it have a value? And if it's not listed anywhere, why would anybody want to buy it? And if they can buy it and it's not listed anywhere, how are they supposed to buy it? So one of the things that is important to us is the ability to, and so I know the rest of the portfolio by heart. The ability to provide liquidity onto centralized, decentralized exchanges, and in particular for stablecoin on and off ramp. because that's something that's really important. As for the others, Neuronomics is an AI portfolio management company, because I foresee a day in the not too distant future where when you speak to an asset manager, they're going to literally say, hey, how much of your portfolio is invested by AI? Because we know that algorithms are able to backtest against data and generate higher returns than even the S&P 500. Which says a lot, because last year the S&P 500 returned 25%. So that means as an asset manager, that's what we're competing against. And that's pretty tough to beat. The other element, DeFi Alpha, is actually very interesting. I think, Ryan, we probably had discussions about this. But having come from the Layer 1 Foundation world, I know something about this. Layer 1s need to finance their operations. And you need what to finance your operations? Liquidity. But a Layer 1 can't go out there and just flood the market with tokens. That would send a very bad signal. Like, could you imagine if, I don't know, the Solana Foundation all of a sudden were to liquidate 10% of their tokens, but then tell you, yeah, it's the greatest thing ever. So what we like to do is provide innovative liquidity solutions directly to the foundations. And we're able to do that in large part because we've listed 85 ETPs, and the founder of our company, Johann Rottenstrom, created the world's first Bitcoin ETP back in May of 2015. So when people are all excited about what's happening in the US, and I say this as a proud Canadian, understand that the real innovation actually came out of Europe. Came out of Sweden. DeFi Ventures, actually, one of those companies shouldn't be up there yet, hasn't been announced, but that's okay. DeFi Ventures is our portfolio, our corporate venture capital portfolio. And one of the entities you see there, Adna Bank, for instance, we were one of the initial investors in one of Switzerland's first two digital asset native banks. And so we're a significant shareholder in Anima. And DeFi Advisory is providing institutional capital markets advisory to oftentimes the digital asset treasury companies. So that is what we do. That is why we do it. Thank you very much for your time.
Thank you for your presentation. Is there anybody that has any questions? There's already a hand raised.
Maybe some questions.
Yeah.
Oh, sorry.
What's your prediction about the digital asset economic for the next 3-5+ years? So will there a bit of evolution, development, or Fortune 500 companies?
Yeah, I think that's a great question. I'll answer it in two phases. So our company is listed on the NASDAQ, and according to our shareholders, because I get their messages directly, everything is turning to shit. And how come the stock prices are higher and all that stuff? But what I can say is, in the corporate world, I think the writing is clear. Whether regulators like it or not, this is moving forward at the highest level. And this is inexorable, much like the internet. So I can't predict which L1 will be the winner, but I can predict that assets will be appearing on chain. Why? Because it's more secure. It was a phony argument that, oh, using blockchain is really, really good, and crypto is really, really good for money launderers. No, it's not. You can trace everything. Now, it is true, maybe money launderers will layer their transactions, or they can steal $1 billion and disperse it amongst 1 billion accounts. That's not that you can't trace it. It's that the cost to trace it is very, very difficult. But this money is far more secure. It's far faster. If you try and send, and I know this from personal experience because this happened to my mom and dad, they tried to send money from an account in Canada or the UK into Ghana, the country of their birth, it took them 6 weeks, and they wanted to send, I think, $60,000. It took them 6 weeks. They had to send it in 6 different transactions, and for each unit of $10,000, they lost $500, right? And the funny thing is, on one of these, I hope, my mom sees that, she'll be like, well, you know, parents are always very secretive. But the funny thing is, for one of those transactions, I was actually in Ghana, and I received a digital asset payment on Cardano for a sizable sum of money, and I just sent the wallet address via WhatsApp, and I received the confirmation in my wallet whilst I was in that third world country. It just doesn't make sense to have to stick to these antiquated rails that don't work. And I think companies are realizing it more and more. They're afraid to acknowledge it. There's a big information gap. A lot of the challenges we have with regulators isn't that they think it's bad, it's that they don't know. And what you don't know, you're afraid of. But the regulators aren't coding the applications. How many regulators do you know who have actually started a career developing code? So even if they try to stop something, they can't really stop it.
But it's also important to have a framework, right? So if you have a framework for your own digital asset company, it's easier to build something system.
Yeah, no, I agree. It's very important to have a framework. But I think we can say definitively, and we're seeing this with AI, the framework will not actually limit the innovations, right? What the framework does is it helps capital flow, so that capital knows they're not investing in something illegal, and it also helps with valuation. So if there's a framework for how this product can be used and the volume of transactions it is allowed to have, right? If you know it's legal, then you can define the total addressable market. If you think it's illegal, then it's sort of tricky to define the total addressable market. But I think without a doubt, I think there's no going back. And that's, I sort of look at a technology in that way. Can it ever be completely reversed? If so, well, then there's risk. But I think with this stuff, even if you don't like it, there's no going back. It's too convenient. Yeah.
One more question. Okay.
Thank you very much.